regarding previous hours.
Okay.
Sir, under repo and reverse repo calculation that.
That is in treasury, boss. Just wait. He will, sir will give. Reverse repo, case study will not come, but in treasury bills it will come. Treasury bill, commercial paper. Okay. And
First leg,
auctioning.
second leg competition is there, no, sir? First leg competition, second leg competition, like that is it is there, no?
Yes. Allotment, first leg, that is auction of treasury bills. It will, I think sir will give. Treasury. It will come, boss. Don't worry.
Hello, sir. Sir, in case of
Yes, boss. CCF. Oh, the chart is on, chart is ready. If you want, I can give right now. CCF chart. Okay. CCF chart ready. And risk weight chart also ready.
Sir, after calculating that CCF, whether we should on that CCF amount?
CCF? No, once you load CCF, then it become a credit exposure. Okay, what is CCF? Credit conversion factor. First you load CCF, then it become a credit exposure. Then you apply the risk weight. Then it will become a risk-weighted assets. We have
to find the risk weight on that CCF amount.
Yes. After after adjusting the CCF only. Okay. Now, are you seeing the screen?
Yes, sir.
Now, are you? Yes. Others. Okay. Friends, we stopped at this point of time. Don't worry. Maybe another 3 hours to now up to 5:10 we'll go. Full speed will go. Then afterwards, change of subject, treasury, sir will do. Treasury or international banking, sir will do. Then 8 I will meet you. From 8 to 10 also I am ready. Don't worry. 8 to 9:30. But to cover the maximum questions, all live questions, I will spend some more time with you. I am ready. Okay. Then tomorrow, same timings, we will do balance sheet analysis, balance sheet management, and the related questions, case study, everything will be together. Okay. Now we have to come up to this point. Now all of you are welcome back after a lunch break. So 30, up to this we had come. Okay. Now there is a small question on 30th question, 30A. Okay. One bank, for example, one bank, okay, some bank, ABC bank, has got NPA 1,000 crores. Okay, there are NPA also. There are 3. Okay, that is different. Substandard, doubtful, and your loss assets. Apart from that, for the purpose of risk weight, it is grouped into 3 categories. For the risk weight, different. It has got NPA 1,000 crores, where the level of provisions, the overall provision, average provisions, okay, aggregate provisions is about 20, but less than 50. About 20, but less than 50. So in this case, the risk weight assigned will be, okay, just 100%. The risk weight assigned for such exposures are 100%. So 1,000 crore, it will become only 1,000 crore. Okay, so the risk weight is 100%. So 1,000 crore is the risk weight. Because 100% risk, this range 20, more than 20, less than 50. Next category you can remember, more than 50, 50 and above. Then automatically 50%, yes, risk weight will be applied. Risk weight is different, provision is different. Okay, friends. So based on the available provisions, risk weight is calculated. So here it is. So 1,000 crore, we got 100% provision. And the capital needed, they will ask 2 questions in one, 2 part. the question will consist of two parts, but only one question. What is the risk weight? What is the capital needed? So two blanks you have to fill up. So both the blanks should be correct because A, B, C, D, they will, 5 options they will give. Correct option you pick up. So 90 crore. Okay, now 31. Next to the last category. Risk weight assigned for NP accounts where the provisions available more than 50, 50 and more than 50, 50% and more than 50. Okay. I think one terminal background noise boss, please. Mute mode. When you want to ask question, you unmute. Okay. Because I am going full screen, I will not know who are all in unmute. Okay, only Biju will come to know. Okay. Now the answer is because the available provisions are already more than 50 and above, the risk weight assigned will be 50 logically. Okay. Because provisions are already available 50, no? So risk weight is also 50. What is the risk weight? This is the percentage the account may go bad. This percentage of accounts may go bad, that may create a loss for the bank. So ABC Bank, NPA, one example, one question, maybe a live question, 1,800 crore, where the overall provisions more than 50%. Already this basket of NPA, already the bank has created provisions more than 50. So sometimes they will give 1,000 crores provision. So that is already 50. Either they will give percentage or they will give a this one. So you have to remember this rule. Okay, up to 20 different, up to 20, 20 to 50, over 50, 50 and above. These things you have to remember. They will not give in the exam. So this is how easily you can remember. I am sharing that chart also. So the risk weight assets will be 1,800 into 50%, 900 crore. So if they want to want the question, capital charge needed, capital needed for this exposure, they will ask 909, 81. So this is 30.
Suma?
Yes, boss.
నేను
I think
రావాలా
one.
సుమా వెళ్ళి వచ్చేయనా ఒక జెరాక్స్ ఇచ్చి
Boss, who is
మాట్లాడుకొని
that
వచ్చేయండి
question?
దా
Please, you ask him to mute. He is not muting at all. Yeah, either you just unmute him or yes, because I repeatedly telling he is not, he is still in okay. They are forgetting, that's the problem. Okay, 32. Risk weight assigned for credit exposure on commercial real estate. There are two type of, that is commercial real estate mean and the construction of commercial complex. Yesterday it was 150% risk. Now it is only 100% risk. Okay, so the commercial real estate, yes, answer is 100%. That is real estate on a commercial basis. But the commercial housing loan is there. Commercial real estate is also there. Commercial housing also there. So here commercial real estate mean complex, malls, big building, office. That is 100% risk. Suppose it's a housing, yes, RBI assigned credit exposure for commercial real estate and subcategory housing loans. They are promoting so many housing loan, corporates, very big flats. So here is a group of houses, apartment, and the housing complexes. Here the risk weight will be not 100%, 75%. Just to promote housing, lesser weight, 75%. Okay, you remember earlier 30%, 50%. Now this is commercial means 70% because always housing loan risk weight will be less, so that the bank will be encouraged to lend more for housing. So that is why the risk weightage is kept deliberately low by Reserve Bank of India. Okay, so that is 33. Now 33rd question, what is concentration? Now some sort of risk also, one or two questions they are asking on some definition of some risk. Earlier, every year they are asking. What is meant by concentration risk? What is meant by non-diversified risk? What is meant by systemic risk? What is meant by funding risk? So many questions. What is meant by call risk? That is small difference will be there. You have to understand. They will give 4 or 5 options. And if you have understood the concept, okay, you can pick up the correct answer. For example, what is concentration risk? This is a popular question because you are giving too many loans to a particular group of borrower. or a group of activity, that is called concentration. So many loans you are giving to real estate, so many loans you are giving to Mukesh Ambani group, so many loans you are giving to Tata group. So that is called concentration. You are giving too much loan to a certain persons. So your bank is having only to selected group of companies. That is called what? Concentration risk. There are so many risk factors. Each one small difference will be there. Risk of excessive lending or making investment based on geographic area. I am putting so much loan in Tamil Nadu, so much, some banks are giving so much loan only in Karnataka, so much loan in Maharashtra. So that is also a concentration risk. So either it may be based on geographic area, it may be based on a particular industry, or it may be based on so much term loan they are giving, project loan they are giving for builders. So that is called under concentration risk. Okay. So they will give the definition. I think all of you can understand, simple way, note down. So 35, sometimes they will ask sovereign risk. 5 options they will give. Some of the frequently asked FAQ, I am sharing with you. Frequently asked question, I am sharing with you. What is sovereign risk? Sovereign risk, you remember, it is default by a government or government agency. Sovereign means it is all associated with the government agency. So the sovereign risk means default in loan provided to government of a sovereign nation. Okay, every nation. Suppose you have given a guarantee to Pakistan, Bangladesh, Sri Lanka. So the Sri Lankan, it is backed by a Sri Lankan government. So the Sri Lankan party has not fulfilled the obligation. Now we are invoking the guarantee. So that is called as what? Sovereign risk. Okay, the governmental agency or government itself, or it is, it is similar to, it is not exactly a country risk. Another question is there. Country risk is also there, but don't get mixed up with country risk and sovereign risk. It is on account of the guarantee given by a government, or whether it may be a local government or some other government, and there is a default in government guarantees. That is called sovereign risk. Government has given a guarantee, but that itself they are unable to pay some issue. So that is called a sovereign risk. Okay, immediately remember government. Then you will not. Then sometimes they are asking funding risk. Always this very FAQ, funding risk. What is funding risk? Sometimes suddenly there may be withdrawal of deposits. Withdrawal of deposit, normally there is a bucket, there is a time bucket. Some accounts will have opened for 1 year. So many crores of deposit will be in 1 year to 3 year bucket, 3 year to 5 year bucket, more than 5 year. But suddenly a mass withdrawal takes place, and we have to fund that unexpected withdrawal. It comes under 2 category. Funding risk comes under need to replace the net outflows due to unanticipated withdrawal or deposit. That also becomes a funding risk from the bank point of view, because they are all risk management. This will also come in balance sheet management also. Okay, all are integrated. Don't worry. Funding risk. Sometimes unanticipated withdrawal of deposit, or sometimes your loan will be pre-closed. The risk of managing cash flow, sometimes you'll have fixed 10-year repayment for a housing loan, group of housing loan, but they will pay it in within 5 years or 6 years. That is pre-closure. So you will get to so much cash flows ahead of the repayment, expected repayment schedule. Then that also the management has to be, you have to manage the funds. That is also funding risk. Funding risk means what? So the cash flow, that is you already marked for the cash flow in 10th year maturity, but it has come. Now you have to do a swapping. So that is also called funding risk. So the funding risk will arise in 2 situations. Okay, unexpected withdrawal or unexpected pre-closure of loans. Okay, so this definition you understand and go through the option, pick up the correct option. Okay, the 37, time risk. The time risk, suddenly some accounts become NPA. Time risk means you think of NPA. Suddenly a standard account, unexpectedly it is slipping into NPA. The performing assets turning into NPA and resulting in cost increase to fund requirement to bridge the gap. You thought it's a standard, will be able to realize. Now this account has become suddenly NPA. So NPA means irrecoverable. So there will be a funds crunch for the bank. Bank thought we will be getting the cash flows on account of the account becoming standard. Suddenly it become NPA mean, so that is called a time risk. How they have got the nomenclature, don't worry, but you have to remember these points. What is time risk mean? This is a definition. Okay, because you have to go, you have to define as per the standards set by Basel Committee. So this is called time risk. Sometime you will come across call risk. Time risk means you remember this. Suddenly accounts becoming NPA. So the adjustment of funds, the cash flow mismatch will be there. That is called timing of the account becoming NPA. That is called time risk. Sometimes they will ask, define call risk. Call risk you are familiar. That is sudden crystallization of non-funded facility. You have issued LC. You thought you will pay the LC. He did not pay. So the non-funded exposure becoming funded exposure, that become call risk. Call risk. That is in outflow, but you have to make payment. You thought he will pay himself the letter of credit. The bankers have got only, it's a letter of credit is a non-fund based commitment. There is no direct outgo, but he did not pay. LC is a commitment for the bank, issuing bank. So now you have to pay. Then it becomes a call risk. Bank due to crystallization of, but the crystallization, you thought the liability will not land on us. He is going to pay. We have given only a commitment, but he did not pay. Then it becomes our commitment. It is our financial outflow. You have to pay. If you have issued a guarantee, our customer does not fulfill the obligations in the guarantee, we have to make the payment. So that is called, yes, call risk. Liabilities such as BG. BG means bank guarantee. LC means letter of credit. Forward contract, some derivative contract. He has not delivered the contract. And okay, he has not picked up the contract. He has cancelled the contract. On account of that, banks are forced to honor that contract because the interbank market will have done. That is called as what? Sudden crystallization of contingent liabilities. That is called call risk. Okay, some nomenclature you remember, you just answer. This is only theoretical question. We will come to that. Strategic risk, because risk also so many questions every year, 1 or 2 questions they are asking. So I'm sharing with you some important, frequently asked strategic risk. What is strategic risk? We'll see. What is compliance risk? 2 questions. What is strategic risk was? Sometimes some business environment. For example, the corona issue came. So for 2 years, the entire industry, the all activities were affected because of frequent lockdown. Factories were closed. So that becomes what? Strategy risk on account of the, sometimes suddenly there is a restriction by the government of India or GST increased something. So the industry as a whole gets affected. Okay. And a competitor coming on the, suddenly a competitor coming into the market. So market was nice. Suddenly some for example, suddenly mobile phone one, suddenly one new company has launched a new mobile phone that is coming into the market. So that sort of risk on account of changes in the market background is called as what? On account of general changes in the market background is called as what? Strategic, or is a strategic risk, not market risk. Market risk is different. The change in price means market risk. But here, because of the changes in the market environment, there is a likelihood of loss. Okay, so that is called as what? A competitor is coming, so you will be posed to the severe competition. So there may be a loss for a particular company. So that is called strategic risk. Compliance risk, all of you know, on account of non-fulfillment of the regulatory guideline. Sometimes, yes, we have to IBC, so many GST guideline. So many guideline from the government of India, statutory guideline, we have to comply with. Even KYC AML is also a statutory guideline. So we are unable to comply with that. Also, it's becoming a risk. Okay, you have to give prior sector advances. You are unable to comply with. Then it becomes a non-compliance risk or compliance risk. Okay, it's a small thing you can remember. Sometimes intrinsic risk. Intrinsic risk also called as inherent risk. Intrinsic risk, for example, film industry, loan, giving so many loans to real estate industry, real estate. They are constructing. Okay, suddenly the demand for housing, commercial complex may come down. It's not steady. Because real estate, lot of money you have to involve. Not all people are capable. So these two, for example, I am telling, some industries, some segment of industries, suddenly there will be lull in the activity. These are all the, okay, for example, investment in stock market is also has got intrinsic risk. All of you remember, if you invest in stock market, you are uncertain about the income. Yes, the stock may give you, the Sensex may go up or come down. So such uncertainty is there in the market or generally. So that is called, yes, particular activity is always film, making film. Some film will, yes, become a hit. Some film you will ban your fingers. So that is called intrinsic risk. Okay, each risk, they will sometimes they will give five, four, five option intelligently they will construct. But when you understand the concept, you don't get confused. Then 42, non-diversified risk. This also they will ask. What is non-diversified risk? Yes, you just see. Yes, the risk that will affect all the players. Non-diversified means you cannot help because Corona, everybody was affected. So that is a Corona environment. Almost all the banks were having problem. All the countries had problem. Okay, so all the industrial units had problem, lockdown, shortage of supply, movement of cargo. So such a situation is called as what? Non-diversifiable risk. That risk that will affect all the players, all the market players, and the functioning of the entire market. That in non-diversifiable. Non-diversifiable means you cannot just minimize the risk or you cannot do anything. That is the meaning of non-diversifiable risk. Okay. Each risk definition, just to have a glance, then you are ready. Diversifiable risk. What is diversifiable risk? Yes, risk of unforeseen event. Okay, that affect a particular industry only, not a entire market. Diversifiable means only a particular industry that is likely to be affected. For example, during Corona, tourism was affected because the no people were able to travel because all restrictions on internal country to country travel restricted. So there is a particular industry was hugely affected. All were affected, but this one particular industry was affected. If you are going to give a loan to that particular segment, then it becomes a diversifiable risk. That is non-diversifiable mean everybody will be affected. Here diversifiable mean so you don't give loan to the film industry, don't give loan to tourism industry. You give some other loan, some other segment you select. So that is called diversifiable. You can you can focus on some other sector. Okay, but this that is why it is called as diversifiable risk. This is nomenclature they have given under Basel guideline. So these are the concepts you have to understand. You have to keep in memory. Okay, two question or one question they will ask always. Now the default risk. What is default risk? You know very well. Okay, we have given a loan, he doesn't pay. So under five circumstances, it becomes what? Default risk. Default risk means contractual default. He agreed to pay every year, every month, every EMI. So that become a credit exposure becoming NPA. So the borrower has defaulted. So it's a default risk. Sometimes you are issuing LC. The customer is unable to pay on the due date. So that also become a default risk. Default risk. LC default. Okay. LC default. Issuing bank not paying. Oh, here you have got a LC. You have discounted the bill under the LC. But the LC issuing bank unable to make the payment. Even if the LC conditions are fulfilled, they are not paying. So that becomes a default. It's a default on the part of the LC issuing bank in the buyer's country. So that is called, that is also. Sometimes we will have issued the LC. We are the importers bank or we are the buyer's bank. Always LC will be opened at the request of the buyer in favor of the seller. So that LC devolved as the buyer unable to pay. The buyer is not able to pay. So then that also, yes, that comes to the heads of the bank. So that also become what? Default. Okay. Guarantee invoked. You have issued a guarantee. These are all credit default. Actually, it's a credit default. So default, which are all the possible credit default? I am giving an example. All example, this they will give in the exam. Either they will give 1, or all the 4, all the 2. Then you have to select yes, 1 A, B, C above, all the situation above. So you read the 5 option necessarily you read. Don't be in a hurry to click 1 or 2. First to full reading you do, then you immediately decide. Okay. So you have to decide within 1 minute. Some questions you can easily 10 seconds, 20 seconds, 30 seconds maximum. Some questions, calculation involved, application of mind involved. Some steps are involved. You do it. Like that you practice. Okay, friends? Now only 1 week, not even 1 week, 5 days time. Interest cash flow. Suppose you have invested in a corporate bond. You thought the company will pay back the bond on the due date or before the due date, but they are unable to pay. The company itself is failing. So that is also become a default risk. Okay, default. That is credit default. You have invested, he is unable to pay. So that is default risk always you can understand. This sort of question they will always ask. Counterparty risk. What is the counterparty? Because the unfamiliar word, some odd words, intrinsic, call risk. So some this one they will systematic risk, strategic risk. So like that, some odd words they will always they are fond of. They will frame questions. Now counterparty risk mean in any contract, especially in a derivative transaction, sometimes 3 people will be involved. Delayed settlement, non-settlement, the committed amount is a contract. The other party to the contract not fulfilling the contractual obligations, then it becomes a risk. Okay, so that risk is not, you cannot call as a credit risk. Credit risk arises when you give the loan. Default risk arises when you defaults. So like that, every situation there will be only minor difference between one risk and other, but you have to clearly understand. Counterparty risk means the other party to a contract may not fulfill the requirements on the contract. So it becomes a, yes, it becomes a counterparty risk, especially in a financial contract and derivatives transaction. One forward contract, option contract, one swap contract. So the other party is not able to fulfill the obligations under the contract. So that is called counterparty risk. Sometimes they are asking. Transfer risk, this is asking. Transfer risk means, don't think our bank employees transfer risk. What is the transfer risk? Sometimes it's actually international risk. Some, suppose you are sending goods to Nigeria. Nigeria. The Nigerian buyer pays him home currency. Nigerian buyer pays, but the Nigerian government unable to convert the Nigerian currency to an international currency like dollar, and they are unable to make the remittance. Okay, so in this case, we are also facing a risk because we have sent that bill to Nigeria. So the Nigerian government, the buyer has paid, but the Nigerian government is unable to transfer the dollar forex because Nigerian currency nobody wants. It has to be converted to a global currency, and the funds have to be transferred out of that country to seller's country. So that is called transfer risk. It is also a part of country risk because the country risk is wide. Country risk is a part of the country risk. Within the country risk, some countries there is a serious forex problem. So transfer means you remember forex. What is forex? Currency other than home currency. So that is called as what? Transfer risk. Okay, shortage of foreign exchange. Maybe their country may have unique problem. Okay. Now another 2 risk only, and a risk also some questions are asking, being asked. That is why I have included. The 47th one is basis risk. This is also they are asking. Basis risk. What is basis risk? Sometimes assets and liability, because there is a benchmark change. For example, repo rate changed, reverse repo changed. Normally bank rates are changing. So, but the assets and liabilities will be priced in a different pattern. Okay, there may not be in an equal degree. Basis risk means what? Supposing repo rate has gone up by 40 points. Now, even loans will go by 40 points. Deposit also you may have to give 40 points, but not exactly 40 points you will not give. Deposit you will give rise to only 30 points, but loans and advances you will raise by 50 points. So this is the degree of changes in the pricing of assets and liability linked to a benchmark rate is called basis risk. Remember, sometimes deposit you will not increase much. Only 20 points you will increase. But loans you will increase 40 points or 50 points. Okay. So linked why you are changing? Because your that reference rates have changed. What's the reference rate? RBI policy rates. Okay, repo, reverse repo. Normally, our bank loans are linked to repo rates. So repo rate changing means that also will affect our lending rate. So this is called basis risk. What is basis risk? Rate of interest on assets or liability deposits. Assets mean loan account changing in different degrees. Here will change by 40 points. Here will change by 20 points. So that is called as what and the key rates, policy rate in the market, that is called basis risk. So closely following will be yield curve risk. Sometimes they will call yield curve risk. Yield curve risk is slightly linked to basis risk, but basis risk is on account of following one reference rate. But the embedded yield curve risk normally by following two reference rates. Sometimes we will some loans will be linked to MIBOR, some loans will be linked to even our RLLR. What is RLLR? Now repo linked lending rate has come. So different stand for different product, and there may not be any uniform movement in the curve, yield curve. Yield curve means, yes, what is the yield on advances? There may not be any uniform movement of the profit margins. So that is called, there will be some unparalleled movement. So that is called as what? Yield curve risk. Some risk, you have to buy heart, no other choice. You have to understand, basically, do not try to mug up. You understand the concept, then it will be clear. Risk on account of a bank pricing assets and liability using two different benchmark rates. Okay, one is linked to MIBOR, one is linked to LIBOR, one is linked to your RLLR. So different benchmark, there will be unparalleled movement in the yield. Okay, your NIA income will be affected. So that will non-parallel movement in yield rate affecting the NIA of the bank. What is NIA? Net interest income. Okay, well, how do you get net interest income? Total income from loans and advances minus, okay, that is total income from assets minus total expenditure towards liabilities. All liabilities you have to pay a cost. Okay, SP account, term deposit. So that is called NII, net interest income. So it is going to affect net interest income because of the different policy rate, different, the curve will go in a different way. That is called as what? They have given the jargon, yield curve risk, you have to memorize. Now risk is, oh, okay, one more risk is there. Systematic risk. Systematic risk is also called as non-diversified risk. Systematic means it will affect the whole industry. For example, Corona. The whole world was affected. Nobody was spared. So risk on account of recession, war, natural disaster, affecting all in the industry, not one particular person, one segment of entire industry paralyzed. That is called systematic risk. Also, just we have discussed non-diversified risk. So this is also called, also known as sometimes systematic risk. The other name they will ask non-diversified risk. Okay, or sometimes non-diversified risk, but the other name for this non-diversified risk, you remember systematic risk, not systemic risk. Systematic risk. Systematic risk means because of the general recession in the industry. Systemic risk means different. It will affect only a particular industry, banking industry. Normally, systemic risk will arise in banking industry because high level of NPA. NPA going up, so that will affect only banking operations. So that is called a systemic risk. It is affecting a particular systematic risk. So small difference will be there. Just to have, keep in mind, don't have to memorize. It's very difficult to memorize, but just to have an idea, logically you understand. So don't miss the question. Then systemic risk means, yes, a particular industry, particular segment. So subprime crisis, for example, Americans were hit by Yes, 2007, 2008, they were all hit by subprime crisis, or it is also called as a financial, financial disaster. Okay, financial tsunami. They used to tell financial tsunami. So that is a particular industry is going to be affected. That is called systemic risk, also called as diversifiable risk. Also called as what? That is non-diversifiable, systematic. This is systemic, diversifiable. These small demarcation difference will be there. You are expected to, yes, remember. This is a definition only, theory question. Now we
Sir,
are
already
coming to
diversifiable risk is there, sir.
which one, madam?
Already diversifiable risk is there.
Already?
Risk of diversifiable risk.
Yes, yes.
Risk of
The other name for diversifiable is systemic risk. It is also called as what? Systemic risk. Okay, sometimes debt equity ratio is also known as leverage ratio, also known as gearing ratio. Sometimes two names will be there. So you have to remember those identical names. Okay, madam. That is why
Sir,
it is also
sir,
called.
already,
Ah,
sir, already diversible risk we have set for that particular industry regarding that, sir. Now again we are saying about systematic risk is also known as diversible risk.
No, systematic risk is little different, madam. That is why small difference will be there. Systematic risk mean systematic. That is why they will always try to give this definition. Systematic mean it will affect the whole country or the whole industry, all industries, especially example Corona. Nobody was safe, unsafe, everybody became unsafe. That is called systematic risk, non-diversifiable risk. But systemic risk means a particular industry, maybe film industry or real estate industry or banking industry, a particular segment of business in a particular industry that is getting affected. That is called systemic risk. Okay. Inherent risk is slightly different. Intrinsic risk. Because small difference will be there, madam. You go through the definition. Just to keep in mind, okay, not many questions will be asked, but you should not take chance,
Okay, sir.
That is why you are expected to be thorough with the definition of this type of risk. One or two questions definitely they are asking. Okay. Sometime in one exam, I remember people told, sir, 5 questions were on definition of risk. Which risk is this? Which risk is there? Funding risk, how it arises. Okay, call risk, how it arises. Timing risk, time risk, how it arises. Okay, one is a contingent liability of the bank. So small question also sometimes they are asking. Okay, now we are coming to 51st question. Large exposure for determining concentration risk. Because concentration is normally you are giving so many loans to a particular group of borrowers or a particular activity, okay, or a particular region. It may be all loans are being given to Delhi people, Delhi units, like that. So many loans are being given only to MSME unit, only to exporters, only to real estate. So that is called as concentration risk. So in the concentration risk, there is one another small definition: large exposure under Basel III, large exposure for determining. I have a large exposure in Reliance. You have a large exposure in a particular company. What is the definition? Definition is simple. The exposure beyond 10% or more of the capital funds of a bank. Ah, remember this definition. They are asking, last year I think they are asking large exposure. Okay. Yes, one more exposure is also there. Okay. Remember, large exposure mean if in a particular
Sir,
group, in a
tier 1 capital ಇಲ್ಲ capital funds of a bank?
capital funds mean tier 1, generally mean tier 1. Tier 1 is called as the core capital. The tier 2
Okay,
is
sir.
all
Okay.
gone capital. That will help you only in the case of a liquidation. Okay, but the core capital is always considered as tier 1. So the 10% or more of the capital funds, core capital, if the particular borrower or a particular group, if you are giving, then that means large exposure. Okay, then one more definition will be surprised. These are the new definitions under the Basel III. Substantial exposure, not exposure. This is large exposure. It is a singular, but there substantial exposure they will not ask. Substantial exposure. Next question you see. This is an important question, friends. Substantial exposures. That is aggregate of so many people you have given. Tata Group, Reliance Group, this group, Adani Group. Okay, so many groups you have given. And a bank, for example, Yes Bank, Axis Bank. I am giving an example. Don't take it seriously. Yes, for example, PNB. PNB are given so much loan. That is not substantial, large exposure on Nirav Modi. Here, substantial exposures mean a group of exposure. That means, what is that? You should remember, all large exposure. Okay, large exposure or yes, earlier we used the word, substantial. Earlier we used the word large exposure. Now we are using the word substantial exposure. It is even still broader. Large exposure itself is more than 10% of the bank's capital in a single group. Now, so many 10%, 20%, so many groups you have given. So ultimately, all this aggregate of exposure that becomes, 800% of the bank's capital. Oh my God. Individually, you are individually exposed limit. And for all the people, there is no, you go on giving, you are keeping your exposure limit. Okay, you are giving loan to Adani, like that. I'm just giving an example. But all this exposure put together for a particular bank, if it exceeds 8 times the bank's capital, 800% means 8 times the paid up capital of the bank, that is tier 1. Okay, tier 2 is only normally tier 2 is only for Basel III angle. Okay, but normally tier 1 is called as the core capital or going concern capital. So here, my God, so many large exposure, the group of all the large exposure when totaled, aggregate, maybe 15 customer or 20 customer or 50 customers, all put together, the bank, the total exposure exceeds 800% of a bank's capital. This group of exposure is classified as substantial exposures. You remember this word? You cannot have another word. Large exposure, substantial exposure. Definitely there will be one question. Understood? Remember the definition. You attend the question. Don't miss the question. Now, RW, restructured housing loan. Again, they have advised a new risk weight. Okay, RW, that is risk weight for restructured housing loan where the LTV, individual LTV, not exceeding 80%. Not exceeding 80% means what? Normal risk weight is 35%. You remember, all of you? LTV not exceeding, loan to value not exceeding 80% mean normal risk weight will be 35. Now it is restructured mean sometimes some housing loans will be restructured. Okay, to avoid becoming NPA, they will do some restructuring, extending the repayment period, thereby reducing the reducing the EMIs, so that it can be prevented from becoming NPA. Okay, even after NPA also they can do restructuring as not as applicable to the category. Yes, yes. Here risk weight is not a NPA. Is the risk weight for for restructured housing loan for LTV. So normal risk weight how much? Normal risk weight 35. So they are telling once you have restructured mean another 28% in addition to the normal risk weight. So 35 is the normal risk weight. Because restructured, another 25%, yes, you have to, it attracts risk weight. It's not a provision. Don't get confused. Risk weight will be still more for the purpose of calculating capital adequacy. So another 20%. So totally 35 plus 25, 60% will be the additional risk weight. Okay, additional risk weight. For substandard also remember, that is for provision. Here risk weight, additional risk weight will be yes, normal plus additional. Okay, this is for yes, if the LTV not exceeding. Next category, LTV exceeding 80. Under the TSA approach, but restructured. That a group of loan or the yes, a cluster of loans restructured under a common package. Now it becomes a restructured. Earlier it was not there. Now it is to avoid becoming a bad assets. So the bankers, that is the individual bank's discretion. They have restructured, but it attracts some additional risk weight because it may become a NPA. Even after restructuring. Why you are restructuring? Because avoid becoming a bad account. Even after restructure, it may go bad. So that is why Basel III cautions you give some additional risk weightage. So here normal risk weight is 50. So the additional you have to restructure, you remember 25%. So 75% will be the total risk weight for restructured housing loan where the LTV, individual LTV is in excess of 80% of the LTV is 80. 80 mean more than 80 mean loan to value. Margin is less than 20. Margin is less than 20. That's the meaning. LTV not exceeding 20, 80 mean margin is 20 and above. Okay, it may be 70, not exceeding 80, exceeding 80. Only two category, but nobody will give 100% in housing loan. LTV, it cannot be 100%. Can be, some banks are going up to beyond 80, 90 also some banks are giving. 90 mean margin will be 10%. 95 and all, no bank is giving. 80 normally, some banks are giving 90%. Okay, so this comes under only two categories, over 80, LTV over 80, LTV less than 80. Okay, so accordingly you have to keep in mind. Now, for example, one question. Okay, on arithmetic. Bright Bank Limited has got credit card receivable, 620 crores. What is the risk weight for this exposure? What is the capital?
125%.
125%.
Correct. First, you have to remember to attempt this question, mathematical question. First, they will not tell what is the risk weight. Is right. So you have to remember credit card mean immediately it should flash. I'm sharing the chart. Just remember the chart. So again, why it has jumped? 620 crore. What is the risk weight for this exposure? What is the capital charge? So first one, risk weight applicable for credit card receivable 125. Okay, I think very often they are asking. So the 620 crore outstanding, that is aggregate for the entire bank. So you have to apply 125 risk weight. So the risk weight will be 775. Okay, 775. Sometimes they will ask, what is the risk weight? What is the capital needed? So for this exposure alone, so 775 into 9%, 6975. Okay, so if you remember this, only two steps, 5 mark, 5 mark, but 5 seconds, 5 seconds. But to do this, you should know this. Okay, 120% you should remember. If you apply any other 150, 100, your final answer may be wrong. So it will mark a wrong answer, you will lose the mark. Okay, so even if you miss one step, because sometimes it may be a yes, they will give one option, they will give yes both risk weight as well as sometimes risk weight to something they will give correctly, and this capital need they will give incorrectly. So both you have to mark C, D, E. That I think all of you are familiar. That is 55. The 55. Now we need to remember. Yes, boss. Please keep it in mute mode when you ask only. Okay, otherwise, some blood noise keeps coming. I think somebody, yes, please. Previous question answer. Huh? Previous question answer, boss. 775. You are 620. You just convert to 125. So it becomes 775 is the risk weight. And the capital needed will be last up. RWR credit card receivable, last up, this one. Yes. 775 is the risk weight, just 9%, boss. So this is capital needs, capital charge. They will use the word capital charge. How much capital? Only for this exposure. It's a credit exposure, no? So the bank is, yes, having a exposure in the form of credit card receivable. Is a due. There may be a default. The bank may not recover. So it becomes a risk. Okay, credit risk. Exposure is a risk. So what is the risk weight? How much capital is needed for this alone. Okay, understood, boss?
Sir,
Only
capital-
two
Okay, sir.
steps.
Thank you, sir. Thank you.
Only
Capital charge is 9% for all categories.
yes. For all categories, capital charge always 9. Whatever be the account, only for risk weight will differ, but final step 9% you calculate. As of now, 9 only. Okay, yes, boss. Because you may wonder, sir, why this 2.5 capital conservation? That is why it is called as capital conservation buffer. Buffer is a buffer capital. Buffer capital means what? Sometimes you have to keep something more to meet your contingency. Okay, sometimes banking system undergoes a big issue. So at that time, you should have still more capital. That is called a buffer capital. So capital conservation, but your calculation purpose for determining risk weight and the capital needed, 9 is okay. That is a buffer. Okay, friends. Now another concept to remember, regulatory haircuts. For some securities, now some securities are only under Basel. Earlier, yes, right from Basel 1, yes, all guideline, they are very highly selective in collateral securities. What is a collateral security? You may wonder. A security other than prime security is collateral security. Okay, for example, who is a good man? A good man is one who is not bad. Then who is a bad man? A bad man is one who is not good. At least you have to define either a good man or bad man. Similar way, what is a prime security? Prime securities are the securities charged to the bank or created by the borrower using the bank loan. That is collateral. That is prime security. You are giving a CCOD. The prime security for CCOD is your stock and receivable, inventory and receivable. Agreed? Okay. But when you give a loan, CCOD loan, the prime security may be CCOD, but still you feel the customer is a risky borrower. You ask for NSE, LIC, okay, just to safeguard your loan portfolio, or sometimes third party guarantee, sometimes equitable mortgage of his house property, so that you'll have adequate collateral mean bankers will be happy. It is a fully secured loan account. Okay, friends, that is the difference between prime security and collateral security. The collateral security will be minimizing our capital requirement. Remember always, the collateral security, prime security also will help us because when you recover. But more than prime security, the collateral security can be easily sold in the market. For example, you have charged NSC. NSC you give to the post office, they will give. Okay. There also haircut is there. Okay. Suppose you are giving LIC policy. LIC surrendered to LIC. They will give the surrender value. You adjust to the loan. Okay. And earlier, even shares of Nifty shares are also accepted as collateral. Now they are not accepting Nifty shares. Shares are not equity instruments, are no longer considered. It's for our loan purposes is a security, but for calculating capital adequacy, Basel III guideline does not recognize Nifty shares also as a approved collateral, and the EMT also. EMT, you are perfectly correct. For sanction purposes, is a collateral. You have created a mortgage transaction, equitable mortgage, you are fine. But Basel III doesn't recognize the equitable mortgage as a approved collateral. So here you see the question, an exposure of 100 lakhs. You have given a loan of 100 lakhs. Okay, maybe individual, it is, yes, backed by gold ornament worth 40 lakhs. He has given is not a gold loan. Gold loan is you have given a loan, the gold has been taken as a collateral security. Okay, what is the value of the gold? 40 lakhs. What is the value of the exposure? Two questions they will ask. What is the value of the exposure after risk mitigation? And what is the capital needed for this charge, for this exposure, or capital charge for this exposure? Here, you have to be little careful because the collateral security accepted is not a prime security, it's not a gold loan. It is a loan, and the gold has been taken as in 40 lakhs only gold has been given. That means it's a collateral security. Now, this collateral security will undergo a haircut. Haircut definition is not down. Haircut means when you sell it in the market, there is a possible loss in the value, erosion in the value. You will not get 100 rupees. Supposing a flat is there, for example, I'm telling. Supposing a gold is there, today it may be okay, but when you sell it in the market, nobody will give a buyer that. They will try to buy at a very low price. Okay, everybody. When it's a distress sale, it will get only a lower sale price. So that is why Basel III tells whenever we are charging some security other than government securities, government security you need not have to apply a haircut, and bank deposit also zero haircut. Bank deposit always bank deposit, no? There will be no erosion in the value. 100 rupees, 100 rupees. Yeah, okay. So zero haircut on certain security. I will give the next list. But some security haircut is essential. What's the haircut, you know? For example, this regulatory haircut is a standard haircut. Advocate under Basel III is a standard, not by is a uniformly applicable. So the gold mean 15% is the standard haircut. You remember, they will not give in the exam. Please remember, they will not give in the exam. They will only tell gold ornament. Now you see the question. So the he has given 100. Now 40 lakhs worth gold he has given. So the haircut adjusted collateral is 40 minus 15%. 15% may be a loss. You will realize, you may not realize the entire 40 lakhs. You may realize only 15% less. So 40 minus 15% less, 34. So the 100 already you have given loan. The 34 anyhow you are going to get by selling the gold. So your collateral adjusted exposure becomes 66. Now is a 100 lakh only you have given 1 crore. Who is that you have not specified? Because the category of the borrower not specified. So you bring him under regulatory retail exposure. Retail loans for individual and partnership, trust, everything, up to 7.5 crore. The risk weight, standard risk weight is 75. So 66 lakhs into 75%. Here actually percent, one percentage missing. So 66 into 70%. 49.5 is the risk weight. This is only a risk weight. No, okay. Risk weight becomes 40. Though you have given a 100 lakhs loan, because of the collateral, actual risk weight will be 49.5. And if it is a capital mean, 49.5 lakhs. Lakhs is here. Again, you don't write 00. 49.5 into 9%, 4.455. 2 digit they will give, or 3 digit also they may give. Click it. So two answers. This is risk weight. This is capital needed. How is it? How many of you understood?
So the 34, how we got, I didn't get actually that 40 minus
40 minus 15%. You take your calculator.
Sir?
15% of 40. 15% of 40, how much? 6. Remember,
Okay.
15% of 40 is 15 into 40, how much? That is why you take your calculator, minus the 15, you just apply your calculator. Minus button you put, 15% you put, percentage button you put, automatically you get 34. Okay. So 34 is definitely you are getting. Though you have given a loan of 100, so 34 you are getting 66. The risk weight assigned this category 75. So final answer over. Maybe
risk weight assigned to that gold category 75, is it? Or like 75?
No. It is not a gold loan. Gold loan mean different. Gold loan mean I think 50 risk weight is different, but it's not a gold loan, madam. It's a loan, but backed by a collateral security gold. So that collateral security will have to be given the haircut. Haircut is a new concept. It is not a new concept. Old concept only, but very nicely used in Basel III guideline. Haircut is nothing but a likely loss, erosion in the marketable value of a security. It may be anything. It may be a bond, it may be a land, it may be forex, it may be gold, anything. yes, you have to subject to haircut.
Yeah, sir. So in this question, 75% risk weight means it is applicable to here what exactly, sir?
After adjusting the collateral, madam. After adjusting 100 lakhs, you are given, madam. First,
Okay.
you adjust the haircut adjusted collateral value. This value, anyhow, you are remaining. You are
Yeah,
going to
yeah.
get certainly. Okay. So 100 minus 34 will become 66. On that, risk weight is, so what is the 75? 75% of this loan may become a NPA. It may become a loss for the bank. So 66, 75, that become 49.5. This much loss bank may face. So for that, what is the capital you are keeping? Capital is this much. You agree, madam? So this is how case to case they will ask. Okay. Now 56, there are another question. This is a theory question. What are the eligible collaterals and credit risk mitigants? They may ask. Under Basel 3, they will use the word under Basel 3, not under our normal guideline, you are accepting even landed property. Yes, collateral securities, even landed property, that is EMT, or sometimes you are yes, taking shares of very big company, TCS shares, okay, Hindustan Liver shares, very big company shares you are taking as a collateral security. NSE, LIC always accepted. So the possible collateral securities now permitted under Basel 3, number one is deposit. Number one is deposit. Deposit of whom? Not other banks. Again, please remember, deposits of other banks will not be now allowed, not allowed by RBI. Is prohibited. Deposit of the same bank will be accepted. It may be with other branch also. Now is a problem. Now is a core bank environment. You can mark lien, but earlier, yes, that was also not permitted. In the same branch, deposit is there. Same branch he has to bring. Then you can give a loan on the security of deposit in the same bank, same branch. Normally, we get to avoid risk. So that is deposit, zero haircut, remember. Gold haircut is 15. Next slide I will show you. Government security, zero haircut. Zero haircut means what? There is no loss. It's a beautiful security. Agreed. KVP, KVP means Kishan Vikas Patra, NSC, National Savings Certificate, LIC, yes.
Central government securities and state government securities, both are accepted?
Yes, yes. Government securities only, central government securities, yes, state government securities also zero risk. Zero risk because it's a security backed by. That is different. Guaranteed that 20 is different. Here, government securities may, yes, is a central government, state government securities because they have themselves given the promissory note or guarantee. So that case, it will not undergo any haircut. These three things are deposit. Okay. KPNIC also, now earlier they were telling 2, 3, 5. Now LIC on the maturity value, but depending on the maturity pattern, that is a different formula. That is a complicated formula. Don't worry. So the here zero haircut. Zero haircut and rated securities. Now earlier Nifty shares were debt securities only, now accepted. Debt securities like, rated security, but it should be rated at least 20, but not more than, risk weight should not be more than 100. A commercial paper or a treasury bills and all government securities or some, yes, normally commercial paper or in a corporate bond you have invested. That also becomes what? A security. It's a security, no? Encashable security. It has got its own value. Uh, Commercial paper mean market is a money market instrument, but a bond mean is a debt market instrument. That also is an approved collateral. That also you can pledge. That also you can pledge. Okay. So these are the approved collaterals and note down, which are not allowed, mortgages and equity shares and convertible bond or convertible shares. It should not be hybrid in nature. Hybrid means either it should be equity also not allowed, convertible bond also not allowed, okay, and mortgages also not allowed as eligible collateral under Basel 3 only for the risk weight, calculating risk weight and calculating capital adequacy. Is not for your sanction. Sanction purpose, your credit sanctions different. You don't worry about the credit sanction. Your
Sir,
sanction authority is always.
What it is mean by mortgages, sir?
Mortgages, madam, landed property, madam. Landed property will be mortgage. That is normally EMT. You can note down mortgages mean within bracket
So
EM transaction.
that are taken, sir, for but
Madam,
that are
that is what I
taken
told
as
you.
security.
Madam, that is a security, valuable security as far as your sanction is concerned. Here, I am explaining these securities are not recognized under Basel III for what purpose only? You tell me, what purpose? For the purpose of calculating capital adequacy, capital requirements, okay, under
Okay.
Basel
Okay.
III. It is valid. Mortgage is valid. It's a good security, madam. Land or property. So many loans are granted on mortgages. So many loans are granted on shares. So bulk share, Infosys share, they are pledging, they are taking loan. Okay. So lien will be marked, everything safe. But it is a credit, it is a available security for your credit exposure. But for calculating the capital adequacy, Basel III does not recognize these collaterals as a eligible credit mitigant for the purpose of reducing capital risk, the risk weight, and risk weight is reduced when capital requirements are reduced. Okay, madam. So to be on the safer side, they are is a prudential, is a because Basel III is a international guideline, madam. It is based on international guideline. So in India also you have to fall in line with that. Okay, so that is why mortgages. Mortgage mean normally in India equitable mortgage. In Indian banks are all having no registered mortgage, nothing. Equitable mortgage, EM transaction. Okay, madam. So
So
now
we are not taking mortgages, sir, for risk
and
mitigation.
yes, risk mitigation under the Basel III guideline only. Is a risk mitigation from your normal credit angle. Your credit sanction angle, everything is a approved collateral. It is a sanction stipulate. Only under which one, madam? Basel III. Distinguish. Basel III, sometimes they do not recognize some risk mitigants, some collaterals are risk mitigants. Risk mitigant mean that to reduce the impact of loss. That to reduce the impact of loss. Okay. For the purpose of capital adequacy and all. Only for that purpose, madam. Otherwise, it's a very good security. Mortgage transaction is very good. So many loans are given on mortgage. Understood? Now you come to the next part. What are eligible collateral? You understood. And what are the credit risk mitigant? And what is the standard regulatory haircut? Regulatory haircut deposit always zero haircut. And gold always 15. Okay, gold always 15. The government securities, all government securities, whether it is central government, state government, normally, mostly, yes, okay, they will only tell government securities, the zero haircut. Zero haircut means what? There is no likely loss while selling. You will get the full value. That is why zero haircut. The KVP NIC also, earlier they had prescribed, now zero haircut. But the dated security, up to 20% risk, I think 15%, that is in a separate circular they are telling. That is, I think tomorrow I will cover that balance sheet management. Normally, these are no regulatory guidelines are there, but now while conveying that LCR, HQLA, they are telling any debt security with rating up to 20%, 15% haircut, more than 20%, up to 100% risk weighted. Okay, BB rated debt instrument, not BB, triple B rated debt instruments, because it attracts a 100% risk weight. So that one haircut will be 50. That will be 50. Haircut means what? Almost 50% of the value you have to minus. Then only you are realistic to be on the safer side for the purpose of calculating capital charge, not for other purposes. That is valid for your loan requirement. So only for the purpose of calculating capital adequacy, capital needs under Basel III guideline, the haircut for debt securities up to 20% risk, 20% risk is 15%, 1.5. More than 20, the regulatory guideline, the regulatory standard haircut is 50%. This they are telling in another text. Yes, tomorrow I am coming for balance sheet management. What is that? I will explain. Okay, madam. So these are the standard haircut. You have to gold always they are giving 15, remember. And LIC and all, now you don't have to put any haircut. NDR value you can minus. Okay. So these are the, and this is very important. Supposing you are given a loan in dollar, he is going to pay in rupee, or the collaterals are in rupee. He is depositing a rupee term deposit as a security. Okay, and he is depositing a bond, something in a different currency, loan in different currency, or collateral in different currency, or collateral in different currency, both are different currency. Then that exposure 8% is the haircut. 8% is the haircut because in the process of changing the currency, you may lose. That is why their regulatory haircut is, the standard haircut is 8%. Remember, the foreign exchange conversion 8%, gold 15. So the standard, you remember, this will give you lot of 1 or 2 marks more, mean you are yes, you are comfortable. Remember, you understood the haircut, how to calculate. Okay. Okay. Now, which are the approved rating agency domestic? Domestically, inland companies, yes, who are approved by Reserve Bank of India. Brickworks rating. Okay.
Sir, hello.
The CARE. Yes, sir.
Sir, brickwork rating is recently removed by SEBI.
Which one?
Brickwork, first one, brickwork rating, India Private Limited. It was recently
Is
removed by
removed.
SEBI. Yes.
Okay,
Yes,
okay.
sir.
Well, brickworks is some problem, I think. Okay, okay. Is removed, you are sure? Correct. Okay.
Yes, sir. Recent circular was.
Yes. Okay. So Brickworks is a Bangalore company. I know that company. Okay, so many retired executives are working in that company. I think there were some issues connected. Okay. So this I will remove us. You are sure? No? So I will remove.
Sir,
Okay.
please check, sir, you check
Sir,
your side before updating.
Up to 31st March 3.
Okay. Up to 31st March.
Yeah. Thereafter,
Okay.
we must advise our customers to change the rating up to 30.
Rating. Yes. Okay. Brickworks, CARE, that is Credit Analysis and Research, that is popularly called as CARE, CRISIL, ICRA, Indian Rating and Research Private Limited, India Rating, and SMERA. SMERA also, earlier they were exclusively doing MSA rating. Now they are also approved SMERA. So these are the approved rating agencies by RBI for the purpose of credit risk rating. What is credit risk rating? Every credit exposure will be rated by the banks.
CANARA is now called
Okay.
Informatics.
Informatics. Okay, that is Informatics. Okay. So yes, I think this is called what? This is India rating, which is called
SMERA, sir.
Okay.
SMERA is also called Informatics.
Okay, Informatics. Okay, so these are the approved by Reserve Bank of India. Now, international rating agencies also, sometimes if they ask, you remember. The international rating agencies approved by Reserve Bank of India, Fitch Global. What you are doing in India is Fitch India. The Fitch is a global rating agency. Fitch Global, Moody's, S&P, popularly known as S&P. Okay, so they are the approved rating agency international. This Dun and Bradstreet is not normally yes, it is more a credit information services. I think it is coming. Okay, so the 15th question, they are international rating agency. Sometimes if they ask, because credit risk rating, because risk is connected to the risk, credit risk rating agencies are called internationally Fitch. Okay, now the CRR is every bank is now, yes, at a liberty to do, but it's a common formula. Normally, the credit risk rating, there are 8 scales normally, but it's not a hard and fast for every bank. So roughly, if they ask any question, normally 8 scales are there. 8 scales mean 8 grades. So number 1, lowest risk, lower risk, low risk, normal risk, moderate risk, high risk, higher risk, highest risk. So logically, the risk rating will be under 8 grades, and they will assign different matrix for different nomenclature for different rating. just keep in mind, they ask how many models are there, popularly, normal models. Okay. Yes, 8 scales are there normally. Okay. Now, the CIBIL, now, even sometimes they are asking this also for credit rating or credit information or credit score. The credit score also is a mitigant, is a risk management technique. To manage a risk in, especially in retail loan, we are first taking a credit score, CIBIL score, then when we are lending. So this is also one of the measures by which we are managing our credit risk. So the current credit score, okay, a CIR, Credit Information Report, normally ranges from 300 to 900. The lowest will be 300, the highest will be 900. But normally banks are preferring 700 to 750 is considered good for the loan, good for the loan exposure. So some banks are even accepting 650, but normally 650 to 750 is the normal range for deciding. That is internal bank. If they ask this, they may not ask because it differs from bank to bank. But if they generally ask what is the normal credit score, okay, CIBIL TransUnion score, normally you tell it is normally ranges from 300 to 900, but the acceptable score is 650, 700, 750. Okay, yes. So that
Sir,
is considered as
previously
suitable.
இந்த கேபிட்டல் கண்டுபிடிக்கிறோம் சார், அது எப்படி சார் கிரெடிட் ரிஸ்க் மிட்டிகன்ட்? அவ்வளோ கேபிட்டல்
Which
வந்து
one?
மார்ஜினா வச்சுக்கணுமா?
Which
previously
one?
எல்லா சம்லயும் கேபிட்டல் கண்டுபிடிச்சோம்ல. we used to
Okay.
calculate.
First என்ன பண்ணோம், exposure minus the haircut adjusted collateral. First haircut adjust பண்ணிட்டு the collateral you have to minus, then as applicable credit risk. I think I have
No,
given
sir,
one.
that I understood. My question is, we used to calculate that capital, no, 9%. What is
yes,
that capital, sir? Whether it is the margin or what is that?
No. This is the capital under Basel III. For every risk.
So what for that capital we are finding, sir? Like here you are saying for mitigating the risk, individual retail.
Okay. That is to absorb the loss, you are building the capital right now. Now, when the account becomes a NPA, there is a three-way hit on the bank, boss. When the account becomes a NPA, there is a three-way hit on the bank. What is the three-way hit? They are losing their interest income, number one. Number two, they are making provisions. The provisions also to absorb a future loss. Even sometimes provisions may not be sufficient. Then what will happen? If the provisions are not sufficient to absorb a loss, then you have to meet the loss out of your capital. Out of your capital. Capital will be the last resort to absorb a capital. Sorry, to absorb a loss in a credit exposure. That is why capital adequacy, CRAR. What is CRAR? Capital to risk weighted assets ratio. That 9% is based on Basel III guideline. You understand what is that 9%? 9%
Yes, sir,
is
understood, sir. Thank you.
Why? What is the capital? Supposing something happened, even provisions are not sufficient, your bank enters in the loss. In the case of Kingfisher, so many. So finally, your loss ultimately will be borne by the capital. Okay, I think any bank suffers a loss, their capital will be deducted, boss. Annually, finally, the loss will not be parked in assets. The loss will be knocked off from the Tier 1 capital, not Tier 2. Tier 1 capital or loss, 200 crores loss. Immediately, their capital will be reduced by 200 at the end of the financial year. Okay, profit will be added, but loss will be immediately deducted. So that is why
that much capital that party or that borrower should bring. That is
no,
what we are trying.
borrower. It's a bank. The bank has to mobilize that capital. The capital is not from customer angle, boss. It is from bank angle. Capital means bank has to absorb the loss because you are given a loan. That loan may become, even after adjusting all the collateral, haircut, everything, still our bank may end up with the loss because you are debiting interest and all. No. So Basel III guideline tells, in the event of an unforeseen loss in respect of a credit exposure, banks should have adequate capital. Okay, case to case we are calculating. This calculate already, it will be calculated in Tier 1. I think you know the CRAR formula. What is the CRAR formula? I will right now, I will tell you. Tier 1 plus Tier 2, Tier 1 plus Tier 2 divided by risk-weighted assets on credit risk-weighted assets plus, okay, risk-weighted assets on market risk-weighted RWA for operation risk into 100. That should be minimum 11.5. That should be minimum 11.5, including CCB. That is, this much capital banks should have. This much capital banks should have.
Sir.
Tier 1, Tier 2. Okay, boss. Tier 2 is maximum 2% only. Tier 2 is restricted to 2% because it is not a strong capital. That I think we'll discuss tomorrow. Okay, balance sheet. It is 62. The 62, yes. There are 4 main credit bureaus: Experian, okay, Equifax, TransUnion, Dun and Bradstreet. Okay, Dun and Bradstreet.
CRIF high mark, sir. Fourth one
Which
should
one,
be CRIF high mark. Fourth one should be CRIF high mark.
Fourth one, not Dun and Bradstreet.
No, sir.
Dun and Bradstreet removed now.
Fourth one is CRIF high mark, sir.
Okay, okay. What is that, boss?
CRIF, CRIF high mark.
I mark,
sir.
Okay. CRIF I mark. Okay. Okay, so this also 62 because lot of changes are taking place, no? So Dun and Bradstreet I have to remove, correct? Credit Information Services. These are all called CIS. CIS, Credit Information Services. Okay. Credit Information Report. Sometimes CIR. CIR abbreviation is Credit Information Report. The entire history of the particular borrower. Okay, payment history. Okay, so sometimes they are asking this also. Now, credit risk derivatives. Credit risk derivatives. What is credit risk derivative? Yes. Sometimes you have given a big corporate loan or not corporate loan. You have invested some investments you have made in a corporate bond. The corporate may default. They may not be able to pay on the due date. That is called as the default on the part of the corporate having issued a bond or debentures. Sometimes they may not be able to pay back redeem the bonds or redeem the debentures on the due date because of their, yes, financial problem. So sometimes, yes, it's a credit derivative. It's not so popular in India, but from CAB angle, they will ask, which are the, okay, inner and all, don't get worried because the last minute, you should not get confused how the CDS works, how the CLN works. These are the credit risk. The forex derivatives are different. Forward contract, option contract, swap contract, FRA, all these are the futures. All these are forex derivatives. And these are credit risk derivative. To manage a exposure, okay, we are given loan or there is a credit exposure. So sometimes they are asking questions on the credit risk derivatives also. So there are 3 derivatives popularly used: TRS, total return swap. So now sometimes which is not a credit risk derivative, they will give the 4th one. You have to find an odd man out. So you remember CDS is also, CDS is considered as a very popular credit risk derivative. Credit risk derivative. Just to eliminate the risk in a, yes, sometimes to minimize, is not eliminating. The derivatives will not totally eliminate the risk. It is only to manage or it's a risk mitigant or reduce the risk, or risk mean probability of loss. That is called credit risk derivatives. Sometimes they are asking what is CDS. CDS means protection buyer, protection seller. The terminology will be different. Yes, we will explain. So the credit linked note means CLN. Okay, based on that is a securitization. This is used in securitization. Securitization means what? Some assets which are very bad shape will be converted to tradable assets. That is called securitization. What is securitization? Some non-tradable assets or illiquid assets or NP accounts will be fine-tuned and it will be securitized. Okay, so NDR, they will reconstruct the portfolio and it will be through a special purpose vehicle. Then what was considered as a bad account may become a tradable account, a saleable account. That process is called as securitization. It's a long-term process. Right now, don't venture into that. Okay, then it will, yes, because the 11th minute you should have complete clarity. 1 or 2 questions are being asked. Don't take the risk. 1 or 2. Okay, credit risk derivatives. Which are the commonly used credit risk derivative? CDS, CLN, TRS. What is TRS? Total return swap. How it is working? Right now, don't worry. Keep it in memory. Now, this definition also sometimes they are asking. Probability of default. Now, after this question, so many, I think next session, 8 to 9, all are arithmetic. Come ready. We may go up to 10:30 also, 10. 8 will start. Actually, 9:30, we may go up to 10 also. So that today we will give fine finish to all risk management. Is a last minute revision. Without any confusion, you should attempt. Now, sometimes what is the definition of PD? Probability of default. How it is calculated, how it is expressed. So there will be theory questions only. Probability of default means possibility of any borrower. He has taken a loan. He is expected to pay the principal amount plus interest amount. So the probability of default is expressed as a percentage. Is a statistically they will express 70% PD. That means 70% of the loan only may be paid. The 30% may become a default. That is PD is expressed as a percentage. Probability of default is expressed as percentage of the exposure. This much is a PD, probability of default. Now it's a new, this is under AARB. There are 3 approaches. Now most of the banks are still in standardized approach, but these are the new approaches for managing or measuring credit risk. AARB, FIRB. What is AARB? Advanced internal rating based approach. What is FIRB? Foundation internal rating based approach. FIRB, AIRB, and the standardized approach. Okay, normally most of the, but this AIRB and FIRB banks have to migrate only with the permission of Reserve Bank of India. They have to develop all rating model. All the rating model Reserve Bank of India has to see, then only. Okay, so here don't worry about the inner detail. Okay, you should have a rough idea about what are these new concepts going to be used in. Yes, measuring the credit risk under advanced approach. Is advanced approach. So the probability of default always will be expressed as a percentage of the exposure. Now why I am coming, sometimes the formula for expected loss you have to remember. Expected loss. One question they may ask, what is expected loss? How to calculate? PD, EAD. They will use the word PD. These are the technical word you have to remember. Why you have to? Yes, you have to remember. What is EAD? The exposure at default. What does it mean? How much loan you have given? How much interest they have to service? So the total exposure is principal plus interest. That is called EAD. Exposure at default. Exposure at default. Okay. Next one is LGD. These are the words they are using in the advanced approach for measuring. So you should know what is the definition. Yes, the EAD we understood. LGD means loss given default. Loss given default. Because the account becomes NPA and while recovering the NPA, bank will have to spend a lot. Bank has to, yes, incur huge expenses. So that may become a loss. So the default given loss, actually it should be default given loss. Or they are not, they are interestingly it is LGD, loss given default. This is actually because of the default, bank is suffering loss. So what is that? The amount the bank may forego after exhausting all the chances of recovery, including enforcement of security, invoking guarantee, sale of securities. Okay, afterwards, still shortfall may be there. You have financed a housing loan. We thought the house is valued 100 lakhs, but when you sell only, we come to know nobody is even wanting to offer beyond 40 lakhs. So entire thing sometimes becomes a loss. So that is becoming a LGD, loss given deep because of the default, bank has suffered. So all these will be used for EL. What is expected loss? Yes, sir. These are the new concepts. Theoretically, you have to understand. Okay, there may not be any numeric problem. Okay, the expected loss. I will give you where are the numerical problems will arise. I think now, okay, the session 3, I think I will give a glimpse of that. Okay, expected loss. What is expected loss? Expected loss means Because of the NPA, you can always foresee, oh, this account has become a NPA. Now on NPA, finally, under the advanced approach, what will be the loss for the banking, for the bank? That is called as EL. Okay, expected loss. And the formula for expected loss is PD into EAD into LGD. Easy formula they will give. Okay, once I think they have asked how to calculate expected loss. So the expected loss is equal to probability of default PD into LGD into exposure at default. The probability of default will be expressed in percentage. The loss given default also will be expressed in yes. The exposure at default will be in amount. The exposure in default will be in quantum, but the probability of default you have to convert to a percentage, always in decimal. I will give an example also. Okay, loss given default. Okay, so the formula only remember. No, don't worry about the calculation and all. Formula remember, because 11th minute you should not load too much. That may yes. Okay, you should have full clarity. So up to yes. Now FIRB just theoretical concepts only. Don't worry. Okay, so it has to be. This is one of the approaches for measuring credit risk. Credit risk, the very popular method is standardized approach. So far you have discussed, 20% zero risk, 30% risk weight, 50% risk weight. These are all under standardized approach. Now every bank, they can develop a model that is called FIRB approach. Foundation internal rating based approach to measure the risk in credit risk, to measure the credit risk only. It is not for market risk or operation risk. So the based on internal rating, every bank can do a internal rating. Automobile sector, fertilizers, okay, agriculture sector, every sector they have their own history, their own experience, bad experience or good experience. So they have to develop a model to measure that. They need not have the corporate, which corporate, what activity they are doing, need not always accept 70, 50, dictated by regulatory authorities. The first one is normally dictated by RBI. Now every bank can decide their own risk parameter. Accordingly, they can reduce their capital adequacy also. But before implementing the model, RBI has to give a nod, the approval. Okay, that is called, this is foundation. This is foundation. The next level is advanced. It's only theoretical. They ask a question is to manage credit risk. It is to measure credit risk. Standardized approach, FIRB, AIRB. Okay, what is expected loss? That is also credit risk measurement. Expected loss. Okay, yes. Now you are coming to 70th question. Now the time is, I think now, maximum risk cover from CGT SME already we have covered. 75% of the loan amount subject to a maximum of 150 lakhs, because now CGT SME has now extended the cover. Earlier they were giving cover up to 100 lakhs without collateral. The banks are lending to MSME, whether it is all inclusive. Please remember, all inclusive. TAM loan, working capital loan, funded limits, okay, non-fund based limits, all together. If they give the loan up to 200 lakhs, if they don't charge any collateral, CGTSM is prepared to give the guarantee. Sorry, the risk cover. They are offering collateral. 75% they are offering. Then what else you want? So even if the loan becomes NPA, okay, 150 lakh, up to this much they are going to give risk cover. So to that extent, banks are safe. Okay, it's one of the credit risk mitigation mechanisms. Okay, 71. Now internal rate mismatch risk, the derivative product. Now we are coming to 71. Okay, shall we go ahead or shall we have to? Oh, you have got a session at 5:30, I think. Yes or no, boss? Yes or no?
Yes, sir. Yes, sir.
Sir,
Yes.
CGT MSC can be covered up to
Okay.
200 lakh, sir.
Huh?
CGT MSC can be covered up to guarantee up to
Yes.
200 lakh.
Yes. For a manufacturing activity, for service activity, they are restricted to 100 lakhs. For manufacturing activity, up to 200 lakhs, you can give a loan, but you don't charge any collateral, including third party. and it can be included in the guarantee scheme. Scheme is available. Okay, even if you give more, okay, but don't charge collateral. If you don't charge collateral up to 200 lakhs, they are giving cover. Okay.
Okay, sir.
Yes. For service unit up to 100 lakhs. Service units up to 100 lakhs. Service and trading units. For manufacturing unit up to
But
200 lakhs.
75% or maximum 150 lakhs only, no sir? Claim.
Yes. 70% or their maximum liability is 150 lakhs. Settlement. Okay. Whichever is lower. Not whichever is higher. Whichever is
That
lower.
is mandatory, sir.
No, it is the discretion of the bank, madam. Mandatory mean up to 10 lakhs mandatory. Every bank, like education loan. Education loan, what is the mandatory? Up to 4 lakh, you are not supposed to insist for any type of collateral. That is mandatory. Afterwards, banks are at a liberty. Similar way, for MSME unit, you should not ask up to 10 lakhs. No collateral you should ask. Up to 10 lakhs SME unit, if it is classified as SME unit, banks have to give without insisting for any collateral security. That is a mandatory guideline. Beyond 10 lakhs, up to 200 lakh is the discretion of the banks. The bank want to waive the collateral security, no collateral security, but still they can cover this under the CGT SME because they are giving collateral. So there is no likely loss. Recovery is assured because of CGT SME. Then why you charge collateral? That is the argument. That's a viewpoint. Agreed, friends? Now we have come up to 70. Now only lot of radical will be starting. 73, 74.
Sir, only two criteria available. For manufacturing sector, it's 150, and service sector, it is 200 lakhs.
Yes, correspondingly, yes. Correspondingly reduced, madam. Correspondingly reduced, correct. Okay. So afterwards, I think up to 70 only. Afterwards, I think numeric. Up to 80. Lot of numerics also. Okay, don't worry. Only theoretical. Basel 3. These are all going to come. Don't worry. We'll meet at 8. Ultimate search score. Okay.
Sir, can you please show me the slide 69 question?
69, don't worry. Yes, here lot of yes. This I will share. Immediately I will share. Lot of questions. Yes. Practical.
Can we have risk weights for different kinds of loans?
Yes, boss. Which one, boss?
How the slide for different risk weights for different kinds of loans, sir?
Okay. Now given, boss. 1 second. I will give. Yes, because I have already listed. The listed 140, 160. Okay, 1 second. I will show the list. Yes, this is the list, boss. This is the list, the standard risk weight, and even I have listed the operational risk. Suppose in beta factor, the standard beta factor for corporate finance 18. So 18, 3 item, 15. So 23 item I have selected, commonly asked. Okay, this is for what risk weight for different. So up to I have given the chart. Yeah, earlier it was in value format. Now we have converted and give to yes. Similar way, I am going to give a chart for CCF also. CCF also the chart is ready. I will share with you.
Okay,
so
sir.
CCF also. These are the this is the CCF. CCF chart also it is going to come. Yes, CCF chart. You see, only 10 item, boss. Collateral LC 20%. Bid bond guarantee 50%. CCF is only a CCF ready-made chart. Ready chart, you can keep it in mind. Performance guarantee mean 50%. Finance guarantee 100%. Standby LC 100%. CCOD 20. Undrawn in the current year. CCOD same year. The term loan in the same year 20. NC year 50. Conditional takeover 50. Unconditional takeover 100. So these are the standard CCF. The chart I will share with you today after concluding the session. Okay, friends?
Okay,
so
sir.
Up to this.
I have a doubt, sir.
Yes, madam.
What is concentration risk? Can you explain?
Concentration risk, madam. You are giving, madam, concentration means you are focusing, you are full focused concentration. I think sometimes, English word, I am fully concentrating on CAB clearance. Are you now concentrating on